Bitcoin is getting crushed. Price is down hard from the peak. Fear is spreading across the market. And right now, millions of people are asking the most dangerous question you can ask at the worst possible time. Is Bitcoin going to zero? That is not just noise. That is not just another bearish headline. That exact wave of panic has appeared before, and each time it showed up, Bitcoin was much closer to a bottom than people realized. Because what just triggered is not some random chart pattern. It is not a whale alert. It is not a rumor from crypto Twitter. It is public search data. Real behavior, real fear. People sitting at home looking at a red portfolio, opening Google, and typing the words that usually only appear when confidence is breaking. Bitcoin zero. And in the United States, that fear signal just exploded to the highest level ever recorded. Think about what that means. Not in theory, in practice. Bitcoin has already fallen more than 50% from the top. The headlines are ugly. Sentiment is dead. The easy money crowd is gone. The people who bought late are underwater. And now the same kind of retail panic that showed up near previous major lows is back again. Bigger than before. Louder than before. More extreme than before. But here is where the story gets much more interesting. Because when you zoom out beyond the United States, the picture changes completely. Global fear already appears to have peaked months ago. The rest of the world is not panicking the way America is panicking right now. Their search interest has cooled. Their emotional reaction has eased. So now you have a split screen. American investors are acting like Bitcoin is finished. The broader global picture is acting like the worst shock may already be behind us. That divergence matters. It matters a lot. Because market bottoms are not usually formed in comfort. They are formed in emotional disorder. They are formed when one part of the market is still capitulating, while another part has already moved on from the panic. That is how bottoms hide in plain sight. They do not ring a bell. They do not arrive with good news. They arrive when people are disgusted, exhausted, and convinced there is no reason left to stay. And that is why this signal deserves attention. Let's start with what the data is actually showing, because most people talk about Google Trends like it is magic, and it is not. It is useful, but only if you understand what it is measuring. Google Trends does not tell you exact search volume. It does not tell you that a specific number of people searched a term on a specific day. What it gives you is relative intensity, a scale from 0 to 100. 100 means that term hit its peak interest within the time frame being measured. It is not absolute. It is relative. That distinction is critical, because when people hear that Bitcoin Zero just hit 100, they assume that means more people searched it now than at any other point in history in raw numerical terms. That may not be true. What it does mean is that relative to the rest of the search activity in that chosen window, this is the strongest moment of fear for that term. In other words, the signal is not about exact body count. It is about emotional intensity. And emotionally, the message is very clear. American retail is in pain. They are not searching for Bitcoin price target. They are not searching for when to buy Bitcoin. They are not searching for next halving cycle or institutional adoption. They are searching for extinction. They are searching for collapse. They are searching for the possibility that the entire thing goes to zero. That is not curiosity. That is panic behavior. That is what people do when price damage has turned psychological. And the timing lines up with that mood perfectly. Bitcoin topped out above six figures in late 2025, then rolled over hard. Since then, the move down has been deep enough and long enough to break confidence. The kind of move that feels less like a correction and more like a betrayal. That is when retail changes language. That is when a dip becomes a disaster in their mind. That is when search behavior becomes a window into capitulation. Now here is the twist. The global data does not confirm the same fresh panic. It tells a different story. Worldwide, fear around this exact search term appears to have peaked earlier, then cooled. That means the United States is not simply mirroring a global emotional wave. It is amplifying its own local one. And that changes how this signal should be read. Because if fear were rising everywhere together right now, you could argue the panic phase is still broadening. But that is not what the split suggests. The split suggests American investors may be late in the emotional cycle. The rest of the world already went through its peak fear phase and has begun moving beyond it. America, meanwhile, is now experiencing the full-force retail flush. Why might that be happening? Because the US investor is not dealing with Bitcoin in isolation. They are dealing with Bitcoin inside a heavy domestic macro fog. Geopolitical tension, tariff stress, weak risk appetite, equity market pressure, non-stop negative headlines. When people are living inside a news cycle that keeps reinforcing fear, they do not just feel worse. They behave worse. They search worse. They sell worse. The emotion compounds. And that is important because bottoms are not just about price. They are about the exhaustion of emotion. Now let's put this into historical context, because the raw data only becomes powerful when you see what happened the last time this emotional signature appeared. Go back to 2021. Bitcoin had ripped higher. Euphoria was everywhere. The asset had gone mainstream in a new way. People were talking about life-changing gains. Then the market cracked. Price fell hard. Confidence collapsed fast. Suddenly, the same people who were celebrating became terrified. And around that fear pocket, searches tied to Bitcoin going to zero spiked. What happened next? Bitcoin bottomed, stabilized, and eventually pushed to a new all-time high later that year. The fear did not mark the death of the cycle. It marked one of the best opportunities inside it. Then came 2022, and the environment was even uglier. That year was not a clean correction. It was a demolition. Blow-ups, bankruptcies, contagion, broken trust, industry-wide embarrassment. Bitcoin fell from the previous peak all the way into the mid-teens. If there was ever a moment when the search term Bitcoin Zero seemed emotionally justified, it was then. And once again, that fear spike appeared close to what became the bear market floor. The pattern is not subtle. Retail panic around extinction language has shown up near major stress lows before. Not once, more than once. Now that does not mean we should blindly worship the signal. That would be lazy analysis. And lazy analysis is exactly how people lose money while thinking they are being smart. There is a major methodological issue here that has to be acknowledged. Bitcoin in 2026 is not Bitcoin in 2021. The user base is larger, the audience is larger, the media footprint is larger, the investor base is broader. Institutions are involved in a way they were not before. ETFs changed access. Bitcoin is now part of mainstream financial conversation, not just crypto-native conversation. That means the baseline level of Bitcoin-related interest is much higher than it used to be. So when Google Trends says the term hit 100 now, that reading sits on top of a much bigger base of total Bitcoin awareness and search activity. In plain English, the room is larger now. The crowd is larger now. The emotional spike might still be real, but the mechanics of how that spike is measured are happening inside a different market structure. That means one thing. You cannot mechanically say this signal is bigger than all previous signals in raw human terms. The methodology does not support that kind of simplistic conclusion. What you can say is that fear is intense enough, relative enough, and visible enough to register as an extreme. And that still matters, because extreme fear is rarely meaningless. So no, this is not a magical button that tells you the exact bottom is in. But it is also not noise. It is a contrarian warning light. A sign that retail pain is reaching levels where forced emotional decisions become far more likely. And that is the zone where markets often begin changing character. Quietly at first, then suddenly. Because this is how bottoms actually form. Not when everyone agrees value is back. Not when the headlines improve. Not when influencers say the coast is clear. Bottoms form when the sellers who are easiest to emotionally break have finally been broken. They sell because they cannot take it anymore. They search because they need emotional confirmation. They look for reasons to give up. And once enough of them are out, the supply of panic sellers starts drying up. That is the real significance of a signal like this. It is a proxy for surrender. The people typing Bitcoin Zero are usually not hardened cycle veterans. They are not the most patient money in the market. They are not the holders who lived through multiple drawdowns and built frameworks for volatility. They are often newer entrants, late cycle buyers. People who believed the narrative on the way up, but were never emotionally prepared for the other half of the journey. When they crack, the market often gets closer to clearing out weak hands, and that is why this current setup is so fascinating. The US signal says American retail may be at or near maximum emotional stress. The global signal says the broader fear wave may already be past its peak. Put those together, and what you get is not certainty, but a very specific kind of late-stage correction environment. Not necessarily the exact final low, but the kind of zone where long-term risk-reward starts changing. That nuance matters, because too many people hear a bottom signal and instantly think it means price can only go up from here in a straight line. That is not how markets work. Bottoms are often messy. They retest, they fake out, they shake confidence again. They frustrate both bulls and bears. Even if this signal is valid, Bitcoin could still chop around, scare people again, even push lower before the larger reversal is complete. That possibility does not invalidate the signal. It defines the nature of real bottoms. Real bottoms are not comfortable entries. They are emotionally expensive entries. Now let's talk about the bigger picture, because this is where the bearish narrative often becomes too shallow. Bitcoin at 60,000 feels awful to someone who bought near the top, but structurally, this is not the same asset it was in earlier cycles. The market around it is deeper, access is broader, institutional participation is more normalized, the narrative base is more mature. None of that removes volatility, but it does change the long-term context in which volatility happens. So when people ask whether Bitcoin going to zero searches are a reason to pay attention, my answer is yes, but not because the search term itself predicts the future. It matters because it reveals the state of the people most likely to make emotionally mistimed decisions. It tells you where retail psychology is, and retail psychology, especially at extremes, has always mattered. There is also a second layer here that few people discuss enough. The most powerful bottom signals are often the ones that feel stupid to trust in real time. If everyone already accepted them, they would stop working. Their power comes from the fact that they emerge in moments when belief is weakest, when price damage is visible, when confidence is broken, when buying feels reckless. That is precisely when they become useful. And that is why this moment deserves respect, because what you are seeing is not just bearishness. You are seeing emotionally concentrated bearishness. You are seeing the kind of fear that distorts perspective, the kind of fear that makes people confuse recent pain with permanent truth, the kind of fear that makes a 50% drawdown feel like proof of total failure. Markets feed on that confusion. Now, could this time be different in the wrong direction? Of course it could. Any honest analysis has to admit that. If macro conditions worsen sharply, this correction can extend. If a major global recession hits hard, risk assets can suffer further. If a new crypto-specific disaster emerges, confidence can be damaged again. If regulation turns more aggressive in a destabilizing way, markets can reprice lower. Signals are not guarantees, they are probabilities wrapped in context. And yes, Bitcoin is larger now, more institutional now, more interconnected with broader risk markets now. That means older cycle signals may not behave with perfect symmetry in a new era. Anyone pretending otherwise is overselling certainty. But uncertainty cuts both ways. Because the same crowd that says this time could be worse also forgets that the long-term case has matured in ways earlier cycles did not enjoy. Scarcity mechanics still matter. Access rails are broader. Public legitimacy is higher. Bitcoin is no longer a fringe conversation. It is embedded in the financial system more deeply than before. That does not remove drawdowns. It changes how those drawdowns should be interpreted. My view is simple. We are likely much later in this correction than the emotional temperature suggests. That does not mean the exact low is already behind us. It means the environment increasingly resembles the kind of late-stage panic zone where patient accumulation has historically outperformed emotional reaction. That is the key distinction. If you are looking for certainty, this market will punish you. If you are looking for a perfect bottom call, you are probably already thinking the wrong way. But if you are looking for moments when fear becomes so loud that long-term opportunity begins hiding underneath it, this is the kind of environment you study very carefully. Because the worst decisions in markets are usually made when pain and narrative line up perfectly. Price is down, headlines are ugly, search behavior is panicked, everyone around you sounds negative. It feels rational to give up. That feeling is exactly what makes the moment dangerous. The people who sold near previous fear spikes were not irrational because they felt scared. They were irrational because they let temporary emotional extremes dictate permanent investment decisions. And once the market turned, they were left outside watching a recovery they had emotionally paid for but failed to benefit from. That is the trap. This signal does not tell you Bitcoin must moon tomorrow. It tells you retail fear has become historically loud again. It tells you surrender language is back. It tells you US investors may be flushing late, while the broader global fear profile has already cooled. It tells you the market may be much closer to exhausting sellers than the headlines want you to believe. And when you put all of that together, the conclusion is not that risk is gone. The conclusion is that the shape of risk is changing. The downside may still exist. But the asymmetry starts looking different when fear reaches these levels. At the top, everyone sees upside and ignores downside. Near major lows, everyone sees downside and ignores upside. That blindness works both ways. So where does that leave us now? It leaves us in a market where panic is obvious, but opportunity is still psychologically unacceptable to most people. It leaves us in a market where the people searching for Bitcoin Zero may be signaling not the end of the story, but the final violent phase of belief being shaken out. It leaves us in a market where discipline matters more than confidence. And it leaves us with a very uncomfortable possibility, that the exact fear making people think Bitcoin is dead may be the same fear that historically showed up right before the next chapter began. That is why this signal matters. Not because it is perfect, not because it guarantees anything, but because it reveals something real. It reveals stress, capitulation, narrative exhaustion, retail pain. And those things, when they reach an extreme, have a habit of appearing near the moments everyone later wishes they handled differently. So here is the real question. When the crowd starts searching for extinction, are they discovering the truth? Or are they advertising the depth of their own capitulation? That is the question this market is forcing people to answer right now. And if history rhymes even one more time, the people panicking the hardest in this phase may end up becoming the fuel for the reversal they cannot currently imagine. Watch the fear. Watch the behavior. Watch what people do when they stop asking how high Bitcoin can go and start asking whether it dies completely. That shift is not random. That shift is where the psychology of bottoms begins. And now I want to hear from you. Do you think this search spike is another classic capitulation signal? Or do you think this time the market still has much more pain ahead? Drop your view in the comments. And if you want more breakdowns built on data, psychology, and real market behavior instead of recycled hype, subscribe now. Because the loudest moments of fear are often the moments that matter most.